This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then, I can focus on what I want to do. Visit learnfuturestoday.com to see what adding futures can do for you.
Hey everybody, Bob Iuorio from the Pure Exposure Growth Series. We had some technical difficulties with our live show this morning, so I wanted to go ahead and get the guests that were supposed to be on, do some sort of pre-tape stuff and talk to them about the market. So my first guest on the live show is going to be Phil Streible of Blue Line Futures, and that is also going to be my guest on this show. Phil, are you with me?
Yeah, I'm with you.
So first of all, I'm saying your name right.
It's Streible.
Okay. I think I've always said your name wrong. I've known you about 10 years. I think I've said it wrong the whole time. You are Chief Market Strategist at Blue Line Futures. Tell me what you do there for them and kind of what your responsibilities entail.
What I do is I coordinate with a team of guys with Oliver and also Bill Baruch. We come up with different macro strategies within the market, segmenting from anything from metals, energies, grains, you name it, interest rates. We design different strategies using futures and options, and then we relay those to clients that we have and help them position the markets and manage risk.
So somebody watching us could be a client, could become a client of yours.
Yeah, absolutely.
So it's futures, futures-based, futures and options. Anything else you guys cover? Is it strictly like CME stuff?
No, we cover all the ICE products, some of the European products, currencies, basically everything. I mean, we're looking for, different opportunities out there within 27 major commodities or futures.
So what do you think of today's moves? Obviously, we got news on the Moderna vaccine, a very small trial, no control group, but they had 8 out of 8 theoretical successes from their trials. They injected people with, essentially they got the body to create similar antibodies to what the body creates after they have fought off COVID-19. So do you think this is, from a global macro perspective, sustainable in what it's trying to achieve from an equity market perspective?
I'll tell you, when I saw that news this morning, and also Fed Chairman Powell last night saying that they were just going to continue to print by any means necessary, you really had to turn the script up, because the way things had ended on Friday's note, it looked like we might have been cycling back lower. So I think some of this news started to leak out a bit. And it's very difficult only having 8, because it goes into the next trial and they might have an expanded category. I've seen this before, expanded number of people in the trial, and it doesn't get the results that they're looking for, and the market reverses course. If you look at U.S. equities, specifically the S&P 500, it's just back at the 200-day moving average. It's back where it was a few times before. It could be a triple top on the charts. So we're cautious here. We are optimistic. We do hope things work out and everything. We want to see this whole situation be resolved, and then we could get more of a trending direction on different markets.
I'm glancing at an hourly chart on Nike right now. Nike would be a stock for me that I think would kind of come back, because it's outdoors, it's athletics, it's getting to the gym, etc. But you look at like the June S&P futures contract, which would be more in your wheelhouse from a futures perspective, still kind of at the high. So do you think this is potentially short covering? Because I know the Commitment of Traders had some pretty big short positions showing up in their reports.
Yeah, there were a lot of shorts coming into Friday. There was lower volume. So towards the end of the day, we'll see how the volume was. And, I think a lot of people are getting tired of these multiple percentage moves, limit down one day, limit up the next day. Type of moves, they tend to drain capital out of people's clients and also discourage them. So I think if you're going to establish longs, it's been a difficult trade to buy these breakouts or sell these breakdowns. But really, I mean, that's always been the best way to do it. Picking tops and picking bottoms, and then it's catching knives and, it eats up a lot of capital.
So as we speak right now, I'm seeing silver up around 2%. You can correct me if I'm wrong on that. I'm looking at my screen to the left here, and I see silver up around 2%. I see gold down around about 2/3%. So, I mean, I know you as a metals guy. I know you as probably the best metals guy out there. So, what would you say from that perspective is the strength behind silver specifically?
So silver should continue to gather steam to the upside. Anytime you look at gold and silver together, you want to look at the gold-silver ratio. Obviously, silver wears two different hats. It has that precious metals, the safety play. It's the poor man's gold. It also has the industrial demand. And I think that seeing where the gold-silver ratio had blown out to 126, that's 126 ounces of silver to buy 1 ounce of gold, it is right that it's normally correcting. Today we saw that dip back below 100. So we are coming back down to more normalized terms, even though normal is still, bad to say because normal is probably closer to 60, 65. We probably come back down to the 80, 85 region. One thing that a lot of people tend to look at was when we saw the industrial production number come out, on Friday. Usually when we see a big miss on that, you'll see the metals act negatively. Well, one small sliver of that number is mining and mining production, which was off big time, which tells me that the supply demand, we start to come back online, and just like automotives are trying to reopen again, you're going to see demand for silver, palladium, platinum, those types of metals, copper, they're all going to go up. And with mining supply down, that's how prices are moving up. And that's why gold or silver is outperforming gold today.
So do you think silver you mentioned is a poor man's gold, and it's something we experienced the last time gold had that classic rally up to 1900 when people started saying gold's too expensive, I'm going to buy silver as a replacement for gold. Do you think it's part that? Do you think it's part potential for infrastructure and rebuilding with the other base metals, or a combination of both?
See, silver, about 60 to 70% of that is this industrial demand. So when you see U.S. equities have big upward moves and big down moves, silver tends to react with them. Now, if you take a broad selection, like if you did your standard deviation curve on people that invest in silver, you're going to see them kind of scattered all over. The one side is going to be the precious metal. The other side is it's just pure form for industrial demand. I think that's where this curve is kind of shifting, and more and more people are buying into this wave. So it's fortunate for those precious metal guys who are getting that boost today.
What about crude oil? How do you feel about energy? I mean, you talk crude oil or natural gas. Natural gas definitely has had some volatility, but crude oil's up above 30. Do you believe this move?
I mean, I was really shocked by this. I think you got to be, cautiously optimistic. 50% of crude oil's demand comes from the road. Another 10% comes from aviation. I don't see people flying, but we do see that road pickup. You already mentioned you're ready to do a road trip down to Florida. I think more and more people, I know a lot of people that drove to Wisconsin, drove to Iowa just because they've lifted these shelter in places. I think that demand, and if you look at like gasoline prices, 1 week they were 90 cents, the next week they were $1.50. So crude oil, it doesn't have business being sub, $20. $25 and $30, probably a more realistic range until you get actual cuts from OPEC that are sustainable and prove that you're not going to see that $35 to $40 range anytime soon.
All right, so we're on the same page on that. OPEC has said a lot of things that they actually haven't fallen through. And a lot of people don't realize from 1986 to about 2001, you had crude oil essentially trading between $9 and $23. And we've already broken above that. So if that's sustainable, do you have any opinion on natural gas, or you just
natural gas? I was looking at the charts today, and it was funny because a lot of people were mentioning that, and I really started looking at it because they were saying that we're going to have this massive heat wave this summer. We've already got a tropical storm developing, so I was like, hey, there's going to be some natural gas demand. You look at the June chart, it goes from the upper left of your screen to the lower right. Clearly, it's in a bear market. You go out to the December natural gas, and it's from the lower left to the upper right. So they are completely different market structures. So we're trying to find right now which contract is going to be the one that's most suitable and what is the best strategy. So natural gas is still in the works as far as Blue Line's concerned.
Do you have a favorite trade right now, number one? And Pilot, finish that off with where people could reach you if they need to.
Yeah, I mean, probably my most favorite trade would be like looking at silver to the upside, something out in December, like a $20, $25 call spread. You buy the 20, you sell the 25. That seems like, it's pretty far out there and you're pretty optimistic, but realistically, we think that the way that the Fed is putting so much money at things, we think inflation will pick up towards the end of the year. That's where I think silver could hit that $22 to $23. Trade costs about $1,500 in order to do. Your max gain's $5,000 on it, but we're really looking for about a $2,500 gain. And then to reach me, you can always go to www.bluelinefutures.com, or you can reach out direct to me at our number 312-858-7303.
Phil Streible, much appreciated. Chief Market Strategist, Blue Line Futures. We're going to have you back on the live show as soon as we can, hopefully in studio. I think you and I'd have fun with that.
Thanks a lot. Thanks for having me, Bob.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit learnfuturestoday.com to see what adding futures can do for you.
All right, we're back as promised with Amelia Bourdeau. Amelia is the founder of Market Compass. She is a global macro specialist, but she's one of the brightest minds in FX that I know. And Amelia, if I could, I think you had probably our best trade of the last 4 or 5 shows. You've been on the show before. So let me just start with asking you what you think as I talk to you right now. This is midday. We've had to move away from the morning show for today. I've got the S&P up 3.3%, the NASDAQ 2.5%, Dow almost 4%, and the Russell up about 6%. Give me your view of just this whole move.
Well, thanks for having me on again. It's great to see you. So the whole move today is driven really, it's obviously a massive risk-seeking day, and it's been driven mostly by the positive vaccine news we're kind of getting out of Moderna. And also in the United Kingdom, they're saying that they may be ready for a vaccine trial by September. The other thing that's quite positive is Chairman Powell of the Federal Reserve spoke to us on Friday at the Peterson Institute, and then again on Sunday night on a 60 Minutes interview. And while he is a little bit downbeat on the economy in terms of the length of the recovery, he was very resolute both times in 2 factors. The first was that the Fed would not go to negative rates, and that's something that the market really wanted to hear. And the second factor was that the Fed would essentially do what it takes to stabilize the financial markets for as long as they have to be stabilized and remain liquid for. And so that boosted sentiment, Sunday night into this morning, along with the positive vaccine news. And I guess the third factor is just more opening up across America. So today, at least in North Florida, where I'm based, restaurants are now moving to 50% capacity indoors, full capacity outdoors, and gyms are open at 50% capacity. So as stuff comes online, it certainly boosts resident sentiment, but it's also boosting the market sentiment as well.
Do you know, this is kind of a backhanded question, but do you know they started at 25% indoors, they're moving to 50% in Florida. Is it because of the heat, or do you not know specifically why it is?
In the press conferences, they're saying that although they don't really have direct scientific data on this, they're saying that outdoor capacity it's better to be outdoors than indoors for the virus for some reason. So they're saying they don't have really the science to back it up, but it is better to be outdoors. So here in Florida, they did move to full capacity and outdoor seating in the restaurants. And so most people actually are preferring to sit outdoors. When I've been to restaurants now that they opened about a week and a half ago. And so it's not without difficulty for the restaurant, because what's happening is, at 25 or 50% capacity, they still have 100% overhead almost. So it's not great for the revenue numbers. The second thing that's happening is positive. People are going to the restaurant. So people aren't afraid. They're showing up. They're ready to spend money. That's really good. The difficult thing is that they haven't been out in so long, Bob, that they are lingering at tables for like an hour and a half. So the restaurant was complaining that they couldn't turn over the table. So I had a reservation like for 8:00 on Saturday night, and we were not seated. We were on time for the reservation, and we're not seated to almost 10:00 at night because people just wouldn't leave the table. So,
wow, you would think a restaurant would be forgiven for saying, please, do you mind?
I know.
And they can't even offer you a drink at the bar now. So
yeah.
I'm on your side on why we're up. But some of the other guys I spoke to said it was more Powell than Moderna. I think it's more Moderna.
Moderna, yeah, it's tough.
I think it's more Moderna than it is Powell. We have Powell speaking tomorrow. My theory. Do you think there's a chance we get an irrational exuberance moment out of him?
It's tough to know. He's spoken so clearly both Friday and Sunday that I think he has to be really careful tomorrow to not deviate at all from those messages. So I'm actually happy that into tomorrow we've heard from him twice in two pretty lengthy interviews for at least a Fed chairman. But anything can happen. The market's really fickle right now. It's chopping around. I mean, March was obviously in equities, obviously a huge drop, but that was due to everything, the sudden stop in the economy, everything shut. Then April, after the closings occurred, the market was very forward looking and being like, all right, we're past the shutdown. We're looking to when things open, and then May, which we're in right now, things are opening, but the market's chopping around because things aren't really opening fast enough. They're not really opening everywhere, but yet it's positive that they're opening. And when are we going to get a vaccine? Positive vaccine news, then maybe the vaccine is delayed. So there's no way to know those things right now. I mean, I'm not a biotech analyst, obviously, but it's this market is choppy because it's very headline driven right now. So I would say, be prepared for everything. And certainly safe havens are still your friend right now.
So let's talk a little bit about, you mentioned the dollar and you mentioned yields.
Yeah.
So I've been looking at yields quite a bit. We saw the 10-year note went from about 64 basis points settle on Friday. It's trading about 71 on yield as I look at it right now. So from a perspective of what that is doing to the dollar and your view on the dollar, again, you're one of the best global macro out there, but your FX is really why we want to talk to you over everybody else. So what's your opinion on the dollar and any sort of relationship you can draw from that?
Today's a weird day because we're so risk seeking, but in general, the dollar is, the world's reserve currency. Clearly, Powell stated that the other day as well, in case there was any confusion. But in any way, it's still the world's safe haven. Yen is not as reliable in terms of, I think, day-to-day trading, and Swiss, clearly the Swiss central bank manages it. So still the dollar is my preferred safe haven currency. And right now with yields in the G10, basically zero for all countries, you have to look at what's the differentiating factor of anything we can trade intra G10. And so I'm looking at sterling because they haven't resolved the Brexit issues yet, which, unfortunately, the UK was on its back foot. The United States was not on its back foot coming into this crisis. We had a strong economy. The UK was already on its back foot coming into this crisis because business investment had tanked in the United Kingdom because they couldn't give businesses any direction on the Brexit issue. So businesses couldn't make future plans. So they're already on their back foot. We have a deadline at the end of this year for a trade deal with the EU, between the UK and the EU. And the negotiations aren't going well. They've been going on for the past couple of weeks. There's a new round coming up June 1st. And we had no positive news out of these trade negotiations. And so the market is starting to realize this. And so, I think the pound right now is my least preferred currency because of this extra burden it's taking on. In addition to the pandemic, it's taking on the unresolved Brexit trade deal with the EU.
Now the pound is up a little bit today, but I think prior we had somewhere in we had somewhere in the range of like 6-7 days down in a row. Don't quote me on the amount. Do you think it's tradable here, or do you want to kind of wait and see it stabilize?
I'd like to wait to see it stabilize. I mean, we were in a range for a while, like 126 the figure, like around 122 the figure. We broke below 122 the figure. So that's really topside resistance. I mean, there is not a rush and immediacy to this trade because, trust me, as this goes on, I think the headlines are going to get more negative for the UK, so I think you have time to get into this trade, time to make sure it remains under 22 the figure. One spot 22 the figure, I'd let it remain that 6B contract for sterling. And, once these negative headlines come about the trade, negotiations kind of not doing so well, I think you have time to get into the trade and short sterling. I like it down even to 118 the figure. So we'll see.
For those of you that don't know, that 6B contract is the British pound futures, relates pretty much almost penny for penny on the dollar or the pound dollar in the cash, right?
Yeah, because the interest rates are, flat basically.
So let me ask you a question about commodity-based currencies, namely the Canadian dollar briefly, and then the New Zealand dollar in Australia to a certain degree. Canadian dollar, we've got the USMCA. We're going to go back into full open economies at some point with the USMCA signed and ratified all around. Do you see any upside for Canada based off of just that, or is it just economies are going to be too slow? And what do you think of Australia and New Zealand, given that they're in that part of the world?
Yeah, I think Aussie Kiwi trade a little different than CAD. So I'll talk about Aussie Kiwi first. Aussie Kiwi are very, global growth sentiment stocks. Okay. And so right now with the U.S. equities rallying, that is lifting Aussie and Kiwi. Aussie is more so correlated lately with the S&P 500 than New Zealand, which has departed a bit from it. And there's reasons for that. Aussie is probably overvalued where it's trading right now. So I don't like to do much with Aussie right now. It's not good to don't fight the S&P 500 with Aussie. You know what I mean? So if it's up, Aussie's most likely going to rally as well as it has been. But I don't like it much higher here. I think it's getting overvalued. So that tells you on a day that S&P turns down when there's negative headlines, which is risk-off sentiment. Be short Aussie. Dollar will most likely be stronger on those days. In terms of Kiwi, it's up today because risk sentiment's up, but it has departed a little bit in its correlation from the S&P 500, not as strongly correlated as Aussie. And I think for that, especially that 6N contract, that's a futures contract for New Zealand, the Reserve Bank of New Zealand recently has talked about going to negative rates and other unconventional measures with their monetary policy. And that currencies really don't like it when central banks mention negative rates. And the RBNZ did. And so that was weighing on Kiwi with the exception of today. But it looks like Reserve Bank New Zealand is going to move in that direction. And so I think eventually, that's going to weigh on Kiwi. So, when we get a day where U.S. equities aren't as strong, that's a good day, I think, to short that 6N contract. And we could look at it moving lower, 58, spot 58, the figure, spot 56.50 maybe are my targets on the downside for that.
Okay. Anything else you want to get out there before we tell everyone where they can get a hold of you if they need to?
That's what I'm looking at right now. You just have to stay really nimble in these markets, especially if you have an FX trade on. We're chopping around. We're looking day to day. So I'm looking at my big market themes. I'm looking at dates, and I'm kind of shrinking the time horizons a little bit and getting smart as to when we can get in. So a lot of this is being driven by the day-to-day moves in equities, and the dollar is still a primary driver of G10 currencies, though the special themes that I mentioned, Brexit, the Reserve Bank New Zealand going to negative rates are things that you want to pay attention to. The other thing that you want to pay attention to for Aussie is any negative headlines with China. So if trade war headlines emerge between the U.S. and China or between China and Australia, that's very negative for the Australian dollar as well. So when a trade war headline pops up, you may want to take a look at your Aussie futures contract.
Amelia, thank you very much again for being here. We'd love to have you back. Tell everybody where they can reach you if they want to interact with you. I know you're very active in terms of updates.
Yes. So you can find me. My website is www.marketcompassllc.com. I do a monthly live event risk webinar, which is actually coming up on Wednesday. But anyway, you can go to the webinar tab on my website and learn all about it and subscribe if you're interested in it. We look cross-asset. We identify Forex trades based on cross-asset moves, and we look at themes driving the market. So even if you're a technical trader, these will help you identify the days you may have more volatility and your levels might break. I'm on Twitter at Amelia Bourdeau, and I'm on Instagram stories at Market Compass, where I do a lot of headline updates on my stories.
Great. Amelia, thanks again for being here. We always love having you. We'll have you back as soon as we can.
Thank you for the invite. Take care.
All right, everybody, I am back. Again, sponsored by CME Group at E-Trade, and I'm here with my partner in Path Trading Partners, Mike Arnold. Mike is the Chief Technical Strategist. He also works as a hedge fund consultant. Mike is all about systems. He's all about price action. So, Mike, let me ask you, we're ripping higher in the equities as I speak to you right now. What's your overall kind of view of things right now?
Well, things are, from a technical and a fundamental level, things are incredibly overbought. We potentially had a sell setup last week of massive head and shoulders in the S&P that we were watching that never triggered it short. And we always wait for the technical trigger. We don't front run anything, even though fundamentally I think things are overvalued and we can still correct. We always wait for the technical entry, which never triggered, and now we're ripping higher. So we're still now in a range that we've been in since about the end of April. We've set this high at 29.65, and I'm talking on the SPE mini futures. And we're ripping up now. We're 29.50. So that's my first key level, the 29.65. If we do get above that, I'm then targeting the 200 simple moving average, which is coming in at 29.95. So essentially that magic 3,000 number, which will be a massive magnet. And then above that, we're still going into an advanced clear path move, something we work on with some of our trading systems, which can take us to about 3105, so 3100.
So do you feel comfortable with the move right now, or you think, what's your level of confidence in terms of overbought, oversold?
Again, we're really overbought in our stock portfolio. We are long. We are under allocated. We're about a 50% allocation. And one of the reasons for that is we can't, especially I can't, who comes up with a lot of setups, can't find good reward to risk. The risk is really outweighing the potential reward. So that's another reason I'm not incredibly comfortable being long, but you got to trust the price action at the end of the day. Whether I think we should go up or down is irrelevant. We'll trade what's going on. The big issue why we're still under allocated is because things are priced to perfection, and the upside potential reward, it doesn't outweigh the downside potential risk. So I can't get a proper reward to risk ratio to get in positions that long-term will be statistically profitable.
So from a perspective of, as of Friday, the NASDAQ was about 8.9% away from its all-time highs. So that's with a predicted worst economy since the 1930s. That's with worst industrial production change on record. That's with an expected GDP that's going to be down double digits when the new one comes out. That's with 35 million people on the unemployment rolls, 22.5 million people on the continuing claims. So is it safe to say that even though you aren't affected by these comments, you're with David Tepper when he said the most overvalued market since the 90s? You're with Peter Boockvar when he said the Fed can't print EBITDA and the Fed can't print jobs. And you're with Goldman Sachs and Jay Powell, who said the risks are to the downside. Is it safe to say that?
Yes.
And you come at that from a price action perspective.
Completely. I will look at the fundamentals, but again, I'm not the world's best fundamental analyst. I am the technical analyst, and I got to trust the technicals. Now, if there's another sell setup, then, a massive sell setup, then we will trade it accordingly. But until that happens, we have to stay long. If I can find stocks or any trades that have a good reward to risk, we will get in them from the long side. There's nothing preventing that. It's just to find those actual trades that are structured properly.
So you're, besides being the chief technical strategist for Pat Trading Partners, you're also the co-portfolio manager for the stock think tank, which, full disclosure, I'm the other co-portfolio manager. We were outperforming the S&P as of Thursday of last week. And then the rallies that we've gotten has probably got the S&P outperforming us now, simply because we're under allocated. Now, over time, when you look at something like the Commitment of Traders report, which I know you don't necessarily go through with a fine-tooth comb, but as of the prior Friday, we had the largest number of shorts in the S&P in 3 years. Do you think some of this move we're seeing today, to me, it was based on Powell's comments over the weekend. This is me speaking, not Mike. Powell's comments over the weekend that the Fed was going to do whatever it took to get the markets, or he said economic stability, but he really means the markets, I believe. And we also had this Moderna vaccine, which had some pretty good results. 8 out of 8 clinical patients showed that their bodies produced the same antibodies as if you have the disease and survived it. So that is some pretty good news. Very small study, but still some pretty good news. My question to you, Mike, is do you think that Commitment of Traders report showing all those shorts, do you think this move could be pumped up a little bit with some short covering? Is that something you've seen in the past?
Yeah, and we've seen a lot of these stocks now that have taken off massively have been some of the more shorted stocks. People were shorting companies that don't historically make a lot of money or net profit overall, but those that we've had rip your face off rallies and all of them, where a lot of the true value stocks where we can find value, they're just not moving. They're ignored or they're still going down. So essentially it's being long, in my view, a bunch of garbage, and it's trading momentum and it's trading with a lot of short covering. And until we get people stop shorting, until people run out of their shorting energy, then we'll keep getting these rallies. People eventually give up and go, all right, I guess I got to be long. Well, that's the time, historically, as you know, that's a lot of times when you start to then get the collapse. Now we'll wait for the technical setups, we'll wait for the technical patterns. But again, everything's priced to perfection. And companies in the second quarter earnings are going to be very interesting.
By the way, we just had Boeing struggle again because of Delta retiring certain fleets and not reordering. We have Uber that announced this morning that they're going to cut 3,000 jobs and close, I believe, 45 offices. We don't necessarily think, and again, I'm speaking for myself, but we don't necessarily think that that's going to end. Mike, from a perspective of stocks you look at for core portfolios, like in the stock think tank, what is like your filters, and why do you use those filters?
Well, we use a number of different value filters to try to find actually profitable companies that are growing, and value's just not necessarily in vogue right now. It's the momentum stocks. It's companies that, they're going to outperform because they're going to just keep growing. And that's what's in vogue. But just because something is in vogue for a little bit does not mean you throw the baby out with the bathwater. We're going to keep using our scans and find long-term companies that are positioned properly and that have good technical setups. And I'll give you an example. Home Depot is now made a new high, higher than the high before the sell-off. And yes, people are buying products from Home Depot. I've been to Home Depot because of some home product where we've been in lockdown. So, but it's nowhere near the people in there before. I talked to them and it's like, yeah, our business is still, people are coming here because they're doing home improvement projects, but it's still, our foot traffic's way down. We're not selling as much. So, and yet the stock's at new highs. So what are you going to do? I mean, we tried to get in that a little bit ago, and it just kept gapping and running away, and we couldn't get proper reward to risk. So hindsight's 2020. I wish we could have gotten a great setup in there, but we couldn't. So we just go to the next.
So you're coming from a perspective of protecting capital is more important than sort of riding these rip your face off waves, especially if you think, like I do, that there's likely to be another sell-off when I think the reality of what's going on in the regular economy and what that means for stock earnings.
Yeah, correct. I'd rather keep, we'll get in things if it's the correct thing to do in terms of reward to risk and a proper setup, but we're going to remain slightly under allocated because there is going to be another great opportunity to purchase things and good companies at good prices with proper reward to risk. It's just not now. And everything is priced literally to perfection or beyond. This does, because I was trading back, in the late 90s, early 2000 before the big collapse then. And this reminds me of that, of just everybody was chasing what I consider, companies that might not be the best long-term investment, but they were ripping higher and everybody was celebrating that and making money off of that. Well, flash forward 6 months, 9 months, and you had a lot of people crying in the street. They don't understand why everything collapsed. So it just reminds me of that same kind of vibe, that saying, talking to people, oh, well, why aren't you in these stocks? Why aren't you in these? Because they don't make the value's not there. The reward's not there. Well, look, it went 10% higher last week. Well, yeah, but you're throwing money at something incredibly risky.
Peter Bookvar, Goldman Sachs, David Tepper, Jerome Powell, and Mike Arnold, all coming at it from different points of view. Mike, where can people find you if they need to find you?
They can go to pathtradingpartners.com and reach out to me through there if they want to find us. We also put up YouTube videos on the Path Trading Partners YouTube channel. There's videos up nearly every day covering, we cover some of the momentum stocks. We also cover cryptocurrencies up there. So if people are interested in that, then they can find us on Path Trading Partners YouTube channel.
Thank you, Michael, and hopefully I get in studio soon because you're on every Pure Exposure show. I will see you on the next show. Thanks again, buddy.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit learnfuturestoday.com to see what adding futures can do for you.
All right, so I am back with Jay Soloff, who is the president and chief strategist of Investors Alley. Jay's been on the show before, a really good friend of the show. And Jay has some really interesting looks at things. So I want to go right to it if I could, Jay. You are looking at a market, same as I am, that is up. Well, let's just I hate using the Dow, really. The S&P is up about what? I'm looking at, let me just get it here so I can quote myself correctly. I am looking at a market that is up. S&P futures. Bear with me. I'm not taking this away from your time. All right, I don't see it here, but it's up a lot. Here we go. S&P futures up about 103, 3.52%. What do you make of this? I think we've talked ad nauseum about what's driving it. What do you make of the move itself?
Well, a lot of it is based on what Powell said over the weekend, that there's no limit to what the Fed will do to prop up the markets. You didn't use the term prop up the markets, obviously, but I think that investors are just looking at the Fed as like the ultimate backstop of the market right now. And anytime, I looked on Friday, Powell said that, or the Fed basically said that they're concerned about asset prices if the pandemic continues. It looked like it might be a big down day opening up today. And then boom, we have the 60 Minutes and whatever else came out over the weekend, basically saying the Fed will do whatever it takes. And the markets love that. I mean, they have for the last decade, at least, any sort of that sort of backstop. And I still think it comes down to the fact that there's no yield in any fixed income. I mean, where are people going to put their money? And big stocks in the U.S. are about as safe as you can get. I don't know necessarily if I agree with that, but I certainly understand that people, they want to put their investments somewhere and with the potential for at least some kind of return. And U.S. stocks are really about as safe as you can get in this current, global environment.
Let me ask you, from a perspective of what's going on overall, last week we had Peter Boockvar say that the Fed can't print EBITDA and can't print jobs. We had David Tepper, which I'm sure you saw, that was the big one that got talked about, where he basically said that this is the most overvalued market he's seen, save for maybe the 90s. We had Jerome Powell say twice, as you just mentioned, one last week, and he's going to be speaking again tomorrow, by the way, but last week he basically said that the risks are to the downside, which I kind of agree with. Goldman Sachs, risks are to the downside. Where do you fall on that? I mean, I look at this rally, and I'll just give you what I'm looking at. I look at this rally as being covering some of the shorts. As of 2 weeks ago, we had the highest short position in the last 3 years in the Commitment of Traders report from the future side. As of last week, it hadn't really shrunk much. Shrank a little bit, but hadn't really shrunk much. And we've got the NASDAQ only about 6% away from its all-time high. So where do you fall into that? Do you think it's overvalued? And I say that as somebody who believes it's overvalued, but is also long.
Yeah, I mean, I don't think that there's any, there's any respectable institutional or sort of professional trader that thinks this is an appropriate valuation. But they also, at the same token, it doesn't mean they won't be long. Just going back to what I said, where else are you going to put your money? I mean, who wants to earn, 0.25% on a 10-year or whatever instrument or whatever it may be? It's just not, it's just not a good environment for earning money in any sort of asset class besides stocks. So at least if you're willing to be nimble, you can go into the short term and get out if you feel there is if you feel there's downside coming. At least most people believe that they can get out. I think the other thing though is I still think there's a lot of players on the sideline. I mean, you look at the creation of retail trading accounts, it's been huge. A lot of people are stuck at home with nothing better to do, and they're taking their money, they're putting into stocks with limited volume from large players. They could easily move the market. So that's another question: is are bigger players going to jump in at some point and cause some a potential bloodbath? That's obviously, there's a lot of this is going to be headline driven. I mean, the news from the Fed was undeniably good for stocks this weekend. Any sort of vaccine news is going to be taken as really bullish. We've had all kinds of really cruddy economic news, and it hasn't had that much of an impact on stock levels. So it's really kind of a strange situation for sure.
So two-part question based on that. You mentioned vaccine news. This morning we got the news that Moderna had a pretty successful early trial. 8 people, no control group, but still, of those 8 people, they got 8 out of 8 in terms of being able to sort of trick the body into producing the antibodies that people who have contracted COVID and survived show the same antibodies. So theoretically, it's an immunity vaccine. That stock is up about 23% right now. It's up more than that. It's come off a little bit. I know you don't trade Moderna, haven't traded Moderna, but from a perspective of what we're seeing in Moderna, you're an options guy. Where do you think there might be potential opportunity, not specifically, from just a general point of view, when you see these kinds of moves in stocks you do trade? What do you kind of look at?
Well, you know, and one of the reasons as an options trader that I'm not generally looking at biotech, particularly ones that are moving because of one specific drug or trial result, is that options kind of price it as a binary thing. It's not like you have a whole lot of opportunity, you know, with sort of media, you know, like, oh, maybe it'll move a little bit, or, you know, maybe it's one of those things where we can buy a multi-directional trade. Those tend to be way too expensive. You basically are pricing it for complete collapse or a total explosion higher. And it makes it very difficult to do more than very basic trading. And even then, it's like, let's say you buy the at-the-money straddle. So you buy the call and the put of whatever the spot price is. It'll be one of those things where it moves 20% and then you break even. So, but it's too dangerous to sell, right? I mean, at the same token, you know, you're like, oh, $20 straddle, I gotta sell that thing. But it you know, what happens is that inevitably you sell that thing and then it moves $30. So it's like, it's one of those things where it's generally too expensive to buy, it's too dangerous to sell, and it makes it really hard to trade those sort of things. I think usually what'll happen, the best case is that if you have some piece of news like we have with Moderna, is that it gets a big move and then it settles down and there's no news for a while, and then you jump in if you know the fundamentals haven't shifted and you have an opinion. You wait for sort of the initial move to calm down, and then maybe volatility drops a little bit and you get an opportunity to get in and at least make a directional opinion through options.
So correct me if I'm not sort of synapsing your idea, if that's a word, or your comment rather. You come from being a market maker, so you have the experience of what options may be pricing in. And so if you're saying a stock like this, specifically biotech as a sector, the options market makers have the knowledge to kind of price things in. Is that what you mean by that?
You know, and it's amazing. They do market make, you know, the specialists and the option specialists who create these markets, and it's unbelievable. It's uncanny how accurate they can be. Amazing how many times you'll look at like an earnings play or an FDA trial play or something, and there'll be a straddle priced for it's essentially betting on how far it's going to move one direction or the other, and the option will end up the stock will end up moving almost exactly to one of those points. You know, it's unbelievable. They're really, really good at it, and I've learned through more air, trial and error, mostly error. It's really, it's really difficult to bet against the experts. I mean, obviously there are times when there are plenty of times where they're wrong, but there are a lot more opportunities where they nail it, and part of that has to do with order flow and things like that. It's not, some of it is a bit of a self-fulfilling prophecy, but again, those are things that are working against you. So I tend to look for opportunities where the options are a lot cheaper. So then if you're wrong, you're like, okay, well, I took a shot. I had the leverage on my side, but I'm live to trade another day sort of situation.
So that actually fits in with the whole sort of theme of pure exposure. Let me ask you, Jay. So Moderna is not the kind of thing that's in your wheelhouse. What is in your wheelhouse, both generally and specifically, if there's anything you're looking at?
I've been really fascinated lately with REITs, with both on the positive and the down and the negative. Normally, you don't want to trade something like a REIT because with options, because they really don't move that much, and so it's like there's not a lot of opportunity either buying or selling the options. But REITs have been all over the place with the pandemic. You on the bear side, you have something like the office REITs, where the commercial REITs, where you see people maybe saying, you know what, I'm never going to go back and work in an office. We're completely capable. And these companies saying, you know what, people can work from home. It's saving us a lot of overhead. And we realize with with video conferencing and everything and Slack and all the other tools that are available and relatively inexpensive, that we can do everything from home. So why do we want to, spend, millions in rent and things like that and utilities? So I've been kind of bearish on that. But lately I've been looking at more of the data storage REITs. And they have been relatively positive. I mean, these have gotten a decent boost lately, like Digital Realty, DLR. It's one of the big ones. They own all these data storage places. You got to figure with all the video communication, everything going online, that data storage is just going to be continue to expand, even if the pandemic resolves itself sooner rather than later, which doesn't seem likely. You got to figure, though, that more and more people are going to be working from home. They're going to need this data storage. And so I look at something like DLR, which is like $130 stock, like selling a put spread in that, something like that, where maybe you're not betting because it's already had a pretty big move. Maybe you're not betting on an upside, but you're saying that it has a floor. And because they've been moving a lot, the options are juiced up a little bit. So you could sell, I looked at it last night, and you could sell the 120, 110 put spread in DLR for about $1.50. It might be a little bit different now, but it's a relatively safe pay. That means it would have to basically go down to as low as it was during the actual crash in March and stay there, which isn't likely, right? And as long as it's somewhere above that 120 strike, collecting $1.50 on a REIT like that is just not something I've really seen in the past. I think they're more of like it's more of like a complementary thing, right? So I mean, you have the cloud with software side of it, but that stuff needs to be stored on servers somewhere, right? I mean, the data and the actual the actual storage part of it, they're likely to outsource unless you're Amazon and you own your own data storage farms or whatever. Then a lot of companies are going through one of these other major REITs, that contracted one way or another. They have their data in some of these places, or a lot of them.
So DLR is only up less than 0.75%. It's about 72 basis points. So you're probably not too far off on that. Could you repeat that trade and when it expires, and then tell people where they can get a hold of you if they need to, Jay?
Sure. That was the June 19th expiration. So the standard June monthly, it was selling the 120 put and buying the 110 put. It was somewhere between $1.25 and $1.50, depending on where the bid-ask spreads are. You could go a little bit safer and do, let's say, the 120, 115, and you probably collect, maybe a little more than half of that in credit, but then your risk is limited. So yeah, I mean, absolutely. Optionfloortrader.com is my website. You want to check it out. Back from my name came back from my market making days on the SIBO. That's optionfloortrader.com. Yeah, so I have stuff that talks about these sort of opportunities all the time.
Right, optionfloortrader.com. Jay Soloff, check him out. And by the way, if you're a fan of Scott Bauer at Prosper Trading, so is Jay, and Scott's a fan of Jay as well. So love having both those guys on the show, and hopefully we can get you on the show at the same time.
That'd be awesome.
All right, Jay, thank you so much. Cheers, everybody. We're going to be back with another guest, so stick with us. Jay, thanks again, buddy.
Thank you, Bob.
All right, everybody, we are back with my good friend Jim Iuorio. Jim Iuorio is a managing director at TJM Institutional Futures. He's also, as you probably know when you see his face, a CNBC contributor. You see him on CNBC all the time. And Jimmy, I want to thank you for being on again. And I really want to get into this whole thing that's going on. We're midday right now. It's about 12:30 Eastern time. We're looking at a pretty strong equity market. Let me just get your general thoughts to start.
Well, it began last night when we saw Powell on 60 Minutes, and he just reiterated what we already do know. And I've always thought, and I've been consistent of this the whole time, there's the obvious antagonist in this whole saga is the economic impact of the shutdowns. But the very clear protagonist as well is a Fed and a federal government that doesn't want asset prices to go down. On March 23rd, he unleashed unlimited QE. Last night on 60 Minutes, he assured everybody that there's plenty of tools left that the Fed to use, and we interpreted that, the market, I mean, as being bullish. Now, today we got some talks and snippets about potential vaccines in the work, and that just threw fuel on the fire as well, too. So it's turned into a pretty good rally. I've thought for the whole time that come June, come July, worries about the virus slip away, the Fed and the federal government's stimulus stays around, and that makes a bullish story.
So that really fits in with your standing in the pro versus pro inaugural video that we did, where you said as long as the Fed's around, we're long. Clearly the Fed started this rally, but how much do you think is the Moderna news, which we'll talk about in a second?
Well, I think that looked like it tacked on about 50 points as well to the market. Those kind of things to me worry me because it always seems like the initial headlines might be more than the actual story is, and I don't know as much about it yet, but I can tell you that the stock market seems to like it pretty good. I'm not sure how long that will last. I put that into the category of things I don't know, and the only thing that stays on the list of things I do know is that Jay Powell will stay long past midnight when this is over.
Yeah, even the Moderna stock's fallen a little bit. It's got a high of about $87 a share right now. We're down at 84, so it lost 3 points of that. The S&P I'm seeing, just so everybody knows what point in time we could demarcate it, with the S&P cash up about 85, so that falls into the 2.97%, and the futures up about 97.25, which falls into 3.42%. So Jimmy, what, from a perspective of, one of the things I've asked you a lot about, because you're probably one of the best Fed watchers out there, one of the better interest rate guys that they let on TV, because they don't like to talk about interest rates unless it's you or Rick. But what do you see in the Treasury markets? Is it telling you anything, or is it just detached now?
It is. And it's so funny because guys like Rick and I, we think the interest rate market is the most interesting because it kind of bleeds into and affects just about everything else. So today, from several of my clients and other people's clients too, I see pricing for negative rates, at least in the first, let's say, 3 years of the yield curve. Now, to me, that's fascinating. I think that's going to be a relatively short-lived thing because when Europe went to negative rates, they were doing that to combat just an absolutely awful economic system. Ours is a more exogenous factor that may or may not stick around over the next few weeks. If you look at the data coming out of Georgia, Texas, and Florida, it seems like we are in the late stages of this. So I don't think we're going to go into negative rates. And I think that might fuel something that smells a little bit like inflation. And that's one of the reasons I think we saw silver and gold spike like we did.
So the XLF is up about 4.5% right now. That's the financial sector ETF for people who don't know. What do you see in treasuries?
The funny about, you mentioned that XLF too, because was it Thursday or Friday? That was the thing that bounced first and started that big reversal. I think, so right now I'm neutral to 10-year, but I eventually think it's going higher, perhaps 1.25. And I think that what needs to happen for that is the same thing that needs to happen to be the catalyst in a lot of other things. And that's some meaty, good news that reflects strong openings. And then all of a sudden we can start to realize that maybe inflation is a real thing.
Now, you said it in the pro versus pro video, and I would strongly advise people go watch that. But characterize your view of how long the Fed's going to be around. Let's say this Moderna vaccine is real.
Well, the Fed, too long. That's it. That's my interpretation. The Fed gets scared, and the Fed errs on the side of boosting asset prices and not leaving too quickly. This is a sad thing that's developed over the last 20 or 30 years that I believe the Fed, it never wants to be sitting at the helm and blamed for risk assets cratering. And I think that creates this weird thing where they stick around too long. We've seen bubbles being expanded in tech stocks. We've seen it in real estate. We've seen it in other things as well, not nearly as advanced as those. But I think that's where the tendency may lie. That's why I want to be in risk assets when this starts to blow over.
But do you want to be long? You mentioned silver. Do you want to be long silver? Do you want to be long gold, or I should say short gold at this point? Or would you rather do one of your...
Even though gold and Bitcoin have not seemed like very good fiat currency proxies during this thing, gold had two different episodes where it seemed like margin calls forced it down between like 60 or $100 all in one day. But I think the fundamental story for silver is good. The fundamental story for silver actually, in my opinion, depended a little bit on the fact that gold and Bitcoin kind of showed themselves as not being very reliable in this. And we've seen a 10% move in silver in 3 days. I am long gold. People on Twitter know exactly why I missed the move in silver, and it had to do with the machinations of my clearing account, and I explained it when I was going in, and I am not long silver and wanted to be long silver at 1606 is where I tried to buy it.
Yeah, we actually tried to get long silver a little bit lower than Friday's low. Unfortunately, we didn't get them off. Let me ask you, you affect a lot of your opinions in options. What are you looking at now? What do you like?
Okay, I have about 6 or 7 different call flies and call condors on to try to take advantage of different aspects of what I think this move will be. And I want to talk about a call condor that I put on this morning, which is interesting. And it's interesting in the fact that it's not working. I'll explain why too. So essentially it was this Friday buying the 29.40, 29.65 call spread. So it's a 25 tick wide call spread, and then selling the 29.70, 29.95 call spread. So it's buying the lower call spread, selling the upper call spread with 5 ticks in between the middle strikes. Now, the advantage of doing a call condor, as you know, but for everyone else, the advantage of doing a call condor over the call fly is that you have that 5-tick range where you can make max profit instead of a single point where you can make max profit in the call fly. Now, you pay a tiny bit more for this. Now, what happened, I put this on today when the futures were trading about 29.10, and right now they're trading almost to 29.50, and I haven't made a penny on it because the market's telling me it's too long. One of the things with call condors too is that if it's further away, it doesn't start to reflect the prices of the move. The delta doesn't start to increase until it gets closer to the expiration date, which is Friday. So this is not work. I still like this trade, and I like some of the other ones I have on because I think 29.60, 29.65, to me, that was those old highs from about 2 weeks ago, and I think it's going to be difficult to get through those. And I can actually even envisioning a poke through it and then a move lower as well too. But I got this for 4.3 ticks, which is a risk of $215 to make a potential 1,035 if you make the full 25 ticks. And you and I both have traded flies and condors long enough to know that you never make the full amount. You know what I mean? You try to make a good profit on it, and you cover it when it's expedient to do so.
Do you have a target? Like, do you say 2 to 1, 1.5 to 1? What do you think? Or it's just situation?
If it still has, like, if today or tomorrow I got 2 to 1, I'd take it off. If the next day I'd need like 2.5 to 1, and then by the day that it's actually going to have a delta, then I get a little bit more greedy on these if it's still in the game, and then I want usually 3 or 4 to 1. But I think that's a great question. I've had to develop a system for that in my head.
So just so everybody knows, Friday expiration, that's a 29.40, 29.65, 29.70, 29.95 call condor. That means buying the 29.40, 29.65 call spread and selling the 29.70, 29.95. Am I correct on that?
That's correct.
All right, so that is called a call condor. And so everybody knows, actually, let me ask you, cheaper right now than when you put it on?
No, it's right about the same as what I put on. Some of the flies I bought this morning too are cheaper than what I put them on, but this one's actually stayed about the same.
And you're going to make money virtually anywhere above, say, 29.45 or so.
Right, as long as it doesn't start blasting above 29.70 and go through 29.95, and then I could lose it back.
Which honestly, and this is a trade example, by the way, from Jimmy. It's not telling you to put this on. It's just what he has on. It's an example of how you can use futures options to express an opinion in the market. And I just want to point out that there's a lot of people out there that believe David Tepper, Peter Bookvar, you know where I'm going, Goldman Sachs, Jerome Powell to a certain degree, that the risks are to the downside. Generally, is that why you want to do a cheap option, $215 risk, which potential for 1,000 gain?
More than just generally. I think it's relatively absolute to me that when we've rallied as much as we have, I get worried. And you know, I don't understand talking to these traders who just seem like they're so cavalier and such cowboys and never have worries. I have worries all the time. I think I was born genetically to be a risk mitigator. And that's why I use options that absolutely define my risk, because I want to be able to sleep soundly at night. Again, that's probably cost me a lot of money over the years, but it's gained me a lot of restful nights.
So lastly, where can people get a hold of you? You got a very active Twitter account. I know that. And then if there's anything else you want to get out there, man, I mean, I love talking to you. I get your market updates on Sunday nights, which are private, to be honest, but hopefully you'll allow me to disseminate them. And if there's anything else you want to get out there, and let me know where people can get a hold of you.
Right now, I'm just putting things out on Twitter, and that's at Jim Iuorio on Twitter. If you follow me, I will at some point in time offend you, and I apologize for that in advance. But hopefully we can have some laughs too and share some market talk. But it's at Jim Iuorio on Twitter. And the notes I send out are mostly just, fairly narrow dissemination at this point in time, but that might broaden out too.
Yeah. So general thoughts. What did we miss? Did we miss anything you like in commodities? Miss anything you like in crude oil, for example? Anything at all? It's just that index is where you're focused.
Just hit crude oil real quick. I think it was funny that a couple of weeks ago, people thought that the same kind of thing could happen that happened last expiration, which, clearly that's a one-time thing where knuckleheads are caught long and all of a sudden, don't have any intention to deliver. But one thing that I want to say is that I think the biggest theme here, and we hit on a tiny bit with the metals, is that the reason silver and gold rallied like they did is the market is starting to question whether or not all these dovish sort of actions are going to be bad for the dollar at some point in time. And the dollar itself, I know, looks like it's staying in a range, but the reality is that it's measured against a bunch of other currencies that also are flawed as well. So I worry about the dollar, and I'm not alone in worrying about the dollar too. And that's what we saw in the reflection of that precious metal group.
So Friday expiration, 29.40, 29.65, 29.70, 29.95. Call Condor. S&P is the underlying. Jimmy, give your Twitter account one more time, please.
At Jim Iuorio. And thanks for having me, Bobby.
Good to talk to you again, buddy. That is it for today, guys. I hope you enjoyed the show. PureExposureGrowthSeries.com. Go there, put your email in so you can get alerts to our live shows and all of the videos that we do. Also, click subscribe on the Pure Exposure Growth channel, Pure Exposure Growth Series YouTube channel. So more subscribers we get, the more of this stuff we'll do. So help us out, and I hope you enjoyed the show. You've been exposed.